When a company issues a convertible debenture, it borrows money just like it would with a standard bond. But at the end of its life, this instrument gives the investor a choice: take a cash repayment or trade the debt for company stock. This dashboard displays the exact terms Z Limited is offering. The face value is 100 rupees, but it's currently trading at 85. It pays an 8% coupon, operates under a 30% corporate tax rate, and matures in exactly 5 years. Because corporate debt interest is tax-deductible, that 8% coupon rate overstates the actual cost. We multiply the 8 rupee interest by 1 minus the 30% tax rate, bringing the true annual cost down to 5 rupees and 60 paise. That 5.60 is the exact out-of-pocket cash the company pays per debenture every year. We use this post-tax interest as our baseline to calculate everything else. Let's fast forward 5 years to maturity. The investor has an ultimatum: take a cash payout with a built-in premium or convert the debenture into equity shares. The cash option guarantees a 100 rupee face value plus a 5% premium, totaling 105 rupees. The conversion option offers 5 equity shares at 16 rupees each, equaling 80 rupees. The scale tips toward the heavier cash payout. The problem provides a history of dividend payments dropping from 8.03 to 5 rupees. While forecasting models use historical data to predict stock prices, solving this baseline problem requires comparing current guaranteed values. The dividends are just a distractor. Given the numbers, any rational investor takes the 105 rupees in cash. The cash option wins. By locking in 105 rupees as our redemption value, we know exactly the final cash outflow the company must prepare for at year 5. This yield-to-maturity approximation formula gives us a rough starting percentage. We input our variables: interest 5.60, redemption value 105, net price 85, and term 5 years. It simplifies to approximately 10.11%, establishing our exact bounds between 10 and 11%. Using the present value method at the 10% lower bound, our total PV is 86.44 rupees. Pause and calculate the 11% upper bound using factors 3.696 and 0.593. Multiplying these factors, your total present value drops to 82.97 rupees. The current market price of the debenture is exactly 85 rupees. Because 85 sits between 82.97 and 86.44, we have mathematically proven the true cost is trapped between 10 and 11%. This descending line graph represents the interpolation process. Think of it as a ladder. The top rung is our 10% rate, generating a present value of 86.44. The bottom rung is the 11% rate, with a present value of 82.97. Our current market price of 85 is the exact target we need to hit on this ladder. To find the precise percentage, we measure how far down the ladder our target sits. We take the partial distance from the top rung to our target, which is 1.44, and divide it by the total distance between the two rungs, which is 3.47. Divide 1.44 by 3.47, and we get 0.41. Add that back to our base rate of 10%, and we arrive at the exact post-tax cost, 10.41%. This checklist breaks down the 4 steps we use to solve the problem. First, calculate the post-tax interest. Second, choose the highest final payout for the redemption value. Third, estimate the yield. And fourth, use present value interpolation for the exact rate. Mastering this sequential method ensures you account for the dual nature of convertible securities, allowing you to accurately price the true cost of debt without getting derailed by distractor data.